Hi there, and welcome to your next learning module. We're going to go over the design and implementation of your first reserve capital account. Now, this module is going to be very quick, and we're going to actually take you through step by step the different aspects of actually building the policy. And the first thing that it starts with is actually creating the account, creating the entity that you're going to use to utilize the reserve capital strategy to finance some of the things in your lifestyle, which by default gives you a full and vibrant retirement. So here's the first step, contract design. It starts with a pledge, which is basically writing a check for the number that you have found, which we talked about before, and going through a full application process. And we use Sales Connection, which is part of our back office here at the Strategic Wealth Network. One of our member advocates or your member advocates or myself will take you through Sales Connection, and that will automatically complete your application process. The application covers everything that has to do with underwriting for maximum human life value. Now, what is maximum human life value? We're actually going to cover that in another module, but basically it's how much you're worth on this planet today. And if you died today, what that would mean to your family, to your business, to your personal economy, what that would be missing out on in future income. What it also does when we're underwriting for maximum human life value, and that does not mean that you're going to actually take all of the human life value if you are offered it. It's basically a health escrow account. So here's a great example that I tell all of my clients. I'm 40 years old today. Almost everyone in my family has either had cancer or died of cancer. So it's a pretty good chance that I'm going to have cancer. So why am I going to wait till I'm 45, 50, 55, even 60 years of age to even think about covering my future income for my family if I was to die all of a sudden? Why am I going to wait that long into the future when I could be escrowing my health and have favorable underwriting and favorable underwriting conditions for protecting almost all of my income in the future? So that's one aspect that really doesn't talk about it really doesn't talk about the reason for the actual life insurance. It talks about the human economic value that you're leaving on the table. Now, there are two things that make up and really accelerate the design of the contract, and that's the base premium and the PUA rider. The base premium is basically what you're paying for in death benefit, and after the first 2 to 3 to 4 to 5 years, and that's pretty big range, but usually after year 3, the death benefit is guaranteed and paid for. And you'll see the acceleration process with the way that we design these contracts. The other rider is the PUA rider, and that's your cash deposit. So anytime you hear me say PUA or cash value, that's what I'm talking about. They're one and the same. So here's our rule of thumb. Here's our rules that actually builds the actual policy. We're going to put $1 of death benefit premium to $2.50 of cash value deposit. So there's $1 of death benefit and there's $2.50 of PUA. Now, this gives you maximum efficiency during the capitalization phase. So what this means, instead of all of your premium going towards the death benefit and you see no economic value whatsoever in the first 5 years, we're going to give you economic value. Now, some of you are going to be able to capitalize the policy from day one, and that's just great. But some others are going to need to ramp up. They're going to need to move away from a debt-based or a cash-based personal economy to a leveraged, utilized economy using this reserve capital strategy. So let's talk about company and contract choices. We're going to go with a non-direct recognition company. Now, what that means is that no matter what is going on with your policy, if there are loans outstanding or not, that means that you are going to enjoy the dividends and the guaranteed interest on that policy. That means that no matter what is going on with that policy, whether you have a loan outstanding or not, you're going to get the same treatment of that policy, of the monies in that policy, as if nothing were going on outside of it. So they're not going to go to, let's use an example of me for a second. They're not going to go to the Brandy Joe Newman drawer, take out my cash value and give it to me, and therefore I just lose the growth on that money. No, the company is going to send me their money and place a lien on the cash value within my policy. So I'm able to take my borrowed funds, my leveraged funds, if you will, and I'm able to place those somewhere else in my personal economy without losing the guaranteed dividends and growth on my cash value within my policy. And that's a little bit of the magic here. That's the non-direct recognition companies that we're going to choose. We're also going to choose a company that has superior cash flow and efficient contract performance. Now, what does that mean? That means that as soon as your check clears, you can take the money out. You can have access and liquidity using that policy and gain access to money using that life insurance company. There are some companies out there that do not allow you to use the money for up to a year, and you have to make special arrangements. You have to basically have a third party being involved. There are other circumstances where they really don't have that good of a dividend rate, and they really don't have that great of an efficient performance within that contract. The other thing we're going to look at with a company is a conservative mutual company. There's two types of life insurance companies in this world. There's a stock-owned life insurance company and a mutual-owned life insurance company. A stock-owned life insurance company, they are beholden to their stockholders. And if you have heard me talk about Wall Street in the past, you'll know that companies beholden to stockholders really aren't in it for me unless I'm a stockholder. But with a mutual owned life insurance company, that means that the policy owners own the company. That means that the company is beholden to its owners, not its stockholders, its owners. And that's what makes up a mutually owned life insurance company, is the policy owners. So let's talk about which kind of contract choices. You can choose a permanently funded contract. Now, this is not Index Universal Life. This is not Universal Life at all. Or a fully funded contract with premium offset. So let's talk about the permanently funded contracts. Those are contracts that are funded until they endow or until the policy owner passes away. Now, a fully funded contract with premium offset means that the policy is going to start running on its own at some point in the future. That could be next year, it could be 10 years, it could be 20 years, it could be 40 years. The way that we design these policies is that if you say at 60 years of age, Brandy Joe, I don't want to pay one single solitary penny more into this contract from outside of my personal economy, I want it to run on its own. So there are several contracts that we design and implement for those types of desires with our member clients. And the reason is because at some point in the future, you would like to have passive income. Now, for some people, they categorize that passive income point as retirement. And that could be the same for you. But at some point in the future, these policies have the ability to run on their own, continue to guarantee the death benefit, continue to guarantee the dividend, and continue to guarantee the liquidity and the cash value growth within the contract. Okay, so let's get into actually completing your application. These are the areas that the application covers. All demographic information. Where are you from? Where are you born? Where do you work? Full medical history. And I mean full medical history. If you've ever had cancer, if anyone in your family has had cancer, heart disease, diabetes, all of these things, major surgeries in the past 10 years, dangerous activities. Dangerous activities include scuba diving, piloting, race car driving, motorcycles, your driver's license history, your driving record, if you've had any DWIs, if you've had any excessive speeding tickets. Multiple tickets within 1 year is not that great of a history. Also, your family history. We're going to talk in depth about beneficiaries and how these are supposed to be appropriately set up for your desires. And also, there's the HIPAA forms and also the Patriot Act forms. The HIPAA forms means that we're actually going to collect all of your medical history and your medical records from all of your doctors, and they're going to be sent to the underwriter's office at the company. The Patriot Act forms are for clarifying where the money comes to, or where the money comes from and where it's going to. And it also protects money laundering activities outside of the U.S. So here's the capitalization phase. So we've created the policy. We have looked at several different illustrations. We have found your number. You are going through underwriting, and now we're going to fund this policy. So how do we fund the policy? Are we going to do it annually, monthly, quarterly, what? Annually, obviously, is more efficient because from day one, the death benefit is guaranteed no matter if you pay a monthly, quarterly, or annually premium. There's a cost to guarantee that death benefit, obviously. So here's the sources of some of the funding. I'm going to help you try and find your number if you haven't found your number already. Existing liquidity. Now, existing liquidity can be from liquidating a brokerage account, like some of our clients have done, or it can be just hoarding cash and you don't know what to do with the cash. Also, a reorganization of assets can sometimes open up some cash flow, and restructuring of income for tax purposes. You'll be talking with Doug Richardson about this in more detail. And obviously your current cash flow. So when we're talking about the sources of the funding, it's always about liquidity and capitalization to begin with. So once we've capitalized the policy, whether that's from day 1 or day 452, I'm going to make you use this money. Whether it's for buying a car, going on vacation, buying a nice item for your home, improving your home, whatever it is, paying for your daughter's wedding, whatever it is, we're going to use it or we're going to lose it. And I can show you the differences between a policy that was never used for anything and a policy that was used constantly for a personal economy. And the difference is dramatic. So we're going to take your first loan, no matter what it is, and we're going to deploy that capital. And most of the time, it's just like what I said. It's major purchases like cars, weddings, vacation, home improvement, an equipment loan for your business. Now, this is where sometimes your CPA needs to be involved. We can involve Doug Richardson if we need to make sure that the interest being paid on this particular loan is tax deductible for you personally or maybe for the business. And obviously what we're going to talk about deploying this capital into later on is productive assets, involving your cash flow in other productive assets that pay you an income. So cash flowing the entity. We're going to take current cash flow, and whether it's going to be car payments, tax payments, or vacation savings. It doesn't really matter what it is. I have a client right now, and actually they're going to be brought up here in one of our case studies, that they pay their car payments, their tax payments, their homeowner's insurance, all of their insurance out of their policies, also all of their vacations. So what does this really do? What it does is it capitalizes more and more on top of itself within the policy just by using their current cash flow. Or cash flowing the policy can also mean buy the deal. So you capitalize a policy, you borrow however much money out, let's say $100,000 out of the policy, you place it with one of our other strategic partners, and that deal gets done, and bam, you just made whatever rate of return. You take the return and the return of the investment and the return on the investment, and you put it back into the policy. And then you take out another loan for the next deal. You never roll one deal into another. You never ever want to do that. You want to rehabilitate that policy. You want to repay the loan for that specific deal, and you want to go in and out of that policy as much as possible within reason. Okay, so here's what I just brought up, the Weems family. They had stagnant capital. They had a lot of cash in a brokerage account. They were paying cash for a lot of their things. They were leasing their automobiles, using their business. They had a lot of interest charges, and they really didn't have any human life value. Obviously they did, but they were not insuring their human life value. And this family is worth multi-millions of dollars. And they knew that they needed to plan for something. They have two beautiful little girls. And they knew that they wanted to make sure that they had a head start with their education. But they really didn't know where to start. They didn't know what really the catalyst was for building that foundation. They really didn't know what the keystone was. So when they met me, they started with one policy on each of the parents, and then now they have multiple policies, and then on the kids as well, and they have multiple cash flow streams going in and out of these policies, which is very easy to organize because it's one draft once a month. And now they have their homeowners insurance paid for, their property taxes paid for. They have all of these things rolling through the policies. That give them a more efficient return on their cash flow than having it sit inside of a brokerage account. And one of the things I want to mention, and I didn't put it here in the slide, and I wish I would have, was when you take a loan out, you're charged an interest rate, which we talked about that in the first module with Sean. If you pay back that loan in full within the year, you are refunded the interest. So is it an interest-free loan? Not quite, because you were charged something to begin with, and it's up to you to repay that loan in a very timely manner. So really, where is the opportunity cost when it comes to taking out loan or multiple loans? There's really not one if you do it the most efficient way possible. So think about that. Here's another case study, the Patty family. This is John and Marshall Patty. They came to me from bankruptcy. Actually, I was the one that said, you really need to file for bankruptcy in a hurry, like tomorrow. They had a failing business. They were brilliant artists and brilliant creators, but running a business just got out of control for them because they were in a losing niche, if you will. They had a antiquated business and tons of overhead, not a lot of liquidity, not a lot of cash flow in the waning years. So they took it upon themselves to bite the bullet, declare bankruptcy. After that, they had a clean slate going forward, reevaluated their life goals and their life streams, and started putting their family first and having that be a priority over what was going on in their businesses. And now they have a mindset of abundance with virtually no drag. There's no debt. There's no credit card debt. There's no enslavement to something that doesn't make them happy. They are responsible for their family, and they have basically given themselves a new life just by not following the crowd and not throwing good money after bad. So take some of these things and make some notes and write them down and call us. So this is where kind of the rubber is meeting the road. This is where you need to make a decision on whether you're going to do this strategy or not. And we're here. We're accessible. You can call your member advocate at the 800 number on the screen, 1-800-376-5057. We have an online live chat support system now that is during regular business hours, 9 to 5 Central Time. And you can also email at any time of the day, advocate@strategic-wealth.net. This system was built for you to get to where you want to go. So remember those things. What I want you to do with this particular module is start thinking about what you actually want to do and what these things are actually for and how you're going to make your contracts the most efficient possible. Again, my name is Brandy Jo Newman, and I want to thank you so much for being a member, and God bless.